Welcome to the Deep Dive. We are tearing apart the latest corporate intel so you don't have to.
And today, we're digging into a really fascinating one, Navan's third quarter earnings for fiscal year 2026. The ticker is NAVN.
Yeah, this call, which was on December 15th, created a ton of confusion. And that's really our mission for you today. We're going to try and make sense of it.
We have to. On one side, you have these incredibly strong growth and efficiency numbers. I mean, just stellar operational results.
But on the other, the stock got absolutely hammered. It dropped almost 12% the next day.
So the big question is why? Why did the market just dump the shares after what looked like a decisive beat? That's what we need to unpack.
Okay, let's start with the top line numbers, because that's where the good news begins.
Right. Revenue came in at $195 million. That's up 29% year over year.
Which was a big beat, right?
Mm-hmm.
Consensus was way lower, around $182 million.
A huge beat. So, right out of the gate, for a newly public company, that looks fantastic. The momentum is clearly there.
But the story gets complicated the second you look at profitability.
It really does. So their non-GAAP EPS, which is sort of the adjusted number, was positive, 14 cents per share.
Okay, that sounds pretty good.
It is. It shows the underlying operation is generating cash. The problem was the GAAP number, the official by-the-book net loss.
And what was that?
It was a loss of $225.4 million.
Wow. Wait, say that again?
$225 million, which works out to a GAAP loss of $4.58 per share.
That is a massive gap between the adjusted profit and the real loss. Why was it so huge?
It's mostly an optics problem tied to the IPO. You have these giant non-cash charges hitting the books. A lot of it is stock-based compensation for employees whose shares just vested.
Ah, okay. So it's not cash going out the door, but it's still a massive number on the income statement.
Exactly. And for investors, seeing that much red ink, minus $225 million, is just a huge psychological barrier, especially for a new stock.
And the market did not hesitate, did it?
Not at all. That share price drop, 11.89%, happened on a massive volume spike. We're talking almost 4 times the normal trading day. That tells you big money was selling.
So investors basically ignored the revenue beat and just focused on that big gap loss and the other risks.
That's the story. They ignored the engine, which when you look under the hood is just running beautifully.
All right, let's look under the hood then. Where do we see that operational strength?
The best place to start is gross booking volume, or GBV. It's the real leading indicator.
And what did that do?
It hit $2.6 billion, which is up 40% year over year.
40%. So that's accelerating even faster than the 29% revenue growth.
Precisely. It's proof that the actual activity on the platform, the travel being booked, is sailing much faster than the revenue they can recognize in one quarter. It signals a really healthy future.
And management seemed confident about the macro environment, too. They said the government shutdown in the fall didn't really affect them.
Not at all. They said October was actually a record month. And they also made sure to remind everyone that Q3 is always their strongest season.
They also talked a lot about winning big corporate clients.
Yeah, the enterprise momentum is a huge part of the story. They mentioned a big KC40 company in Europe, Frasers Group, Axel Springer.
And they clarified that when they win one of these, it's not a small pilot program.
No, it's the whole thing, the whole company, globally. They used Visa Energy as an example. When they came on board, it was for all 15,000 employees worldwide.
That's a massive level of commitment. It really locks in future business.
And this is where the story gets really interesting. You connect that growth to their margins, and you see this incredible efficiency story unfolding.
Driven by AI, right?
Driven completely by AI. Their non-GAAP gross margin hit a record 74%.
74? That's a huge jump.
It's a 200 basis point expansion year over year. And this isn't a one-off. They have structurally improved their margin profile. This is the new baseline.
What's the tech behind it?
It's an AI agent named Ava, which is powered by their own in-house framework called Navan Cognition. And this thing is incredibly effective.
How effective?
As of November, Ava was deflecting over 54% of all customer support interactions.
54%. So more than half the time someone needs help, an AI handles it start to finish.
That's it. No expensive human agent needed. And that translates directly into lower servicing costs and, well, a 74% gross margin. It's their competitive moat.
And on top of that, they're improving their supply access with things like direct connections to Emirates and Qantas.
Right, which just makes the product stickier for those big enterprise clients. So
Yeah.
we look at all that, and the operational picture is, it's almost perfect.
But then we have to pivot to the risks because something spooked the market badly.
And there were two big ones. First, a leadership change.
The CFO, Amy Butte, is leaving.
She's departing on January 9th, and they've named an interim CFO. For a company that just went public, an unexpected CFO departure is not ideal. It adds a ton of execution risk.
Yeah, the timing is just awful, right, as they're trying to prove their financial stability to Wall Street.
Terrible timing. And it plays right into the second area of concern, which was their cash flow.
They're still burning cash, right? Free cash flow is negative.
It was negative $11.4 million in the quarter. But to be fair, management gave a very clear timeline on that.
What did they promise?
They committed to being free cash flow positive for the full fiscal year of 2027. So there's a light at the end of the tunnel.
But investors were clearly more focused on the immediate tunnel, not the light.
Especially after they heard the guidance for the fourth quarter, this is really where the floor fell out.
So the Q4 revenue projection was fine. Between 161 and 163 million, that's just seasonal holiday slowdown.
Right, that was expected. The killer was the margin guidance.
What did they guide for?
They guided to a non-GAAP operating loss of between $14.5 and $15.5 million for Q4.
A loss. They just posted a 13% positive operating margin.
I know. This guidance implies a negative 9% margin at the midpoint for Q4. It's a massive, massive swing from one quarter to the next.
It's like slamming the car into reverse. Why are they doing that? Is the business falling apart?
No, it's the opposite. It's a strategic, planned investment. They're taking all that IPO cash and they are stepping on the gas.
Investing in what, specifically?
Foundational AI, a new platform called Navan Edge, and expanding their payments business. They're intentionally taking a short-term hit to build the infrastructure for their next big growth phase.
A phase that they said won't even really contribute to revenue until fiscal 28.
Exactly. So they're asking the market to be patient. And, well, the market hates that, especially for a new IPO that's already down 35% from its first day of trading.
Which brings us back to the central question. Why is such a brutal reaction? It feels like an overreaction.
It's classic post-IPO psychology. You had two clear catalysts for a sell-off, and the short-term money just bolted.
Catalyst number one being the huge, scary-looking gap loss.
Yep. Over $200 million. Momentum traders don't stop to read the footnotes about stock-based comp. They just see a giant loss and they sell.
And catalyst number two was the CFO leaving.
The surprise CFO departure. It just screams execution risk right before a big investment cycle. So those two things completely overshadowed the 40% GBV growth and the record margins.
So the market is giving them basically zero credit for the AI engine and the structural advantages they've built.
For now, yes. Management did point out that being public is helping them win those big enterprise deals against legacy guys like Concur or Amex GBT. So there are tailwinds.
Let's touch on one last detail, the usage yield.
Right. That's what they make on each booking. It was 6.9%, a little down year over year, but they expect to keep it stable around 7% long term.
And that's a balancing act, isn't it?
It is. They have headwinds from some legacy businesses, but big tailwinds from getting more hotel bookings and, crucially, getting more people to use the Navan payment cards. That's the key to keeping that yield high.
So you have this stock trading on completely conflicting signals. High volatility, a lot of confusion.
Which brings us to our final segment, where we try to find an opportunity in that confusion.
This is not financial advice.
Okay. So our premise is that the market is overreacting. It's punishing the stock for a temporary seasonal investment dip and a personnel change.
While ignoring the really durable long-term strength.
Exactly. The 40% GBV growth and that proven 74% AI-driven gross margin, that's their real profit potential.
So if the stock has been unfairly punished, what's the outrageous but plausible trade?
The trade is to bet against this Q4 trough. The thesis is simple. The seasonality will pass, the investment is strategic, and that AI efficiency engine is not going anywhere.
So how would you structure a bet like that?
You'd buy an out-of-the-money call option that expires in May of 2026.
Okay, why May?
Because that gives you time. It gets you past the Q4 earnings report, and it lets the market start looking ahead to fiscal 27 when they're marching toward that free cash flow positive commitment.
So you're basically betting that once the short-term noise dies down, the market will wake up and realize the underlying business is incredibly strong.
That's the play. You're betting on the AI engine over the seasonal headwind.
A bold contrarian pitch. I like it. Let's wrap this up.
The key takeaways are simple. Navan showed incredible growth and operational mastery, hitting that record 74% gross margin thanks to their AI, Ava.
But all of that good news was completely buried by the guidance for a painful Q4 investment cycle and the surprise departure of their CFO.
Right. The market is worried about the cost of growth and execution. So the final provocative thought for you to think about is this.
Go on.
Navan is spending a fortune to build this new Navan Edge platform. If their AI, Ava, can already deflect 54% of customer issues today, how much higher can that AI leverage push their gross margins in the future? And will that insane efficiency be enough to pay for this huge investment surge they're planning for next year?
That is the multi-million-dollar question. The engine is proven, but the bill is coming due. Thanks for joining us for the deep dive.
We'll catch you on the next call.